Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon and get to the real story behind the numbers, especially when it comes to financial reports. And this one has quite a few surprises, a mixed bag. Let's just say, today we are diving deep into a report filed by CE Exchange Traded Funds, a company you might not have heard of, but the numbers we found inside tell a fascinating story about their recent performance and the strategies they are using to navigate the market. It's an N-CSR report. And while that might sound a bit dry, we uncovered some really interesting financial details and risks that are worth paying attention to. Now, CE Exchange Traded Funds put out their annual shareholder report for the year ending the 30th of September 2025, and it gives us a look under the hood of their CE DBI Multi Strategy Alternative ETF, which they also call QALT to keep things simple. Let's just say this fund is all about using complex financial tools to try and make money in different market conditions. When we look at how this fund performed since it started, if we had invested $10,000 in it back in September 2023, it would have grown to about $11,260 by September 2025. That sounds pretty good, right? It outperformed its benchmark, the Bloomberg US Aggregate Bond Index, which only grew to about $11,108 during the same period. So for long-term growth, it seems to be doing its job. But here is where things get a little more nuanced. The report tells us that for the 12 months ending the 30th of September 2025, the fund actually underperformed its benchmark, the ICE BOFA US 3 month Treasury Bill Index. This means that over the last year, the fund did not make as much money as that simple government bill index did, so the long-term picture looks okay, but the short-term picture has some red flags. The fund manager, Dynamic Beta Investments, DBI, uses a lot of futures contracts to make its moves, and that is what they say led to gains in equity trading, but losses in currency and fixed income trading. Essentially, they bet on the good times in stocks, but got hit by ups and downs in currencies and bonds. Let's look at some specific numbers if we check the average annual total returns as of the 30th of September 2025. The CE DBI Multi-Strategy Alternative ETF had a one-year return of 3.19%. That is not bad, but the ICE BOFA US 3 month Treasury Bill Index, that benchmark I mentioned earlier, actually did better with a 4.38% return. So over the last year, the fund lost ground compared to that very safe investment. However, when we look at the annualized return since its inception, which was the 30th of June 2023, the fund did better with a 5.40% return compared to the Treasury Bill Index at 4.96%. Again, the long-term trend looks better than the short-term performance. Something else that catches the eye are the key fund statistics. As of the 30th of September 2025, total net assets were $188,904,000. That is a decent size fund, but the number of holdings is only 14. This means the fund is very concentrated. It is not spread out across many different investments, which can be good for focus, but also increases risk if one of those 14 investments goes south. And what is it invested in? The asset weighting section is pretty brief, showing only 0.6% in futures contracts. That seems a little low given the earlier discussion about futures being a core strategy. But then we see the top 10 holdings, and they are mostly indices like the MSCI Emerging Markets Index and the S&P 500 Index E-mini. This tells us the fund is using these contracts to bet on the overall direction of these big market indexes. The percentages are tiny though, like 0.4% for MSI Emerging Markets and 0.2% for S&P 500 E-mini. This suggests the fund is using these futures in a very tactical way rather than as a dominant part of its portfolio. We also see some interesting futures contracts listed in the schedule of investments, for example, futures contracts on currencies like odd currency and Euro FX, and also on things like the US 10-year Treasury note and the S&P Mid-Cap 400 Index. This shows the fund is actively trading across different asset classes, trying to profit from price movements. Some of these are long positions and some are short positions, meaning they are betting on prices going up and down. For instance, they have long contracts for the MSCI Emerging Markets, but short contracts for things like US long Treasury bonds and CAD currency. This active trading style is often what is called a hedge fund strategy, and it is complex. Now, for a big change one that always makes us look closely at the numbers, the CE DBI Multi-Strategy Alternative ETF reorganized from a different fund called CE Institutional Managed Trust Liquid Alternative Fund. This happened effective the 22nd of August 2025. Essentially, one fund merged into another. They say the investment goals and strategies are the same, but anytime there is a reorganization, we want to see if it leads to better outcomes for investors, or just higher fees and complications. They claim it was in the best interest of shareholders, and that the new structure will mean lower expenses and the ability to trade throughout the day, which is a big deal for an ETF. Let's not forget the accountants KPMG LLP billed the registrant aggregate fees, and when we look at all the fees and services to service affiliates that did not require approval, we see a pretty large number for fiscal year 2025. It was $291,683, and for fiscal year 2024, it was $359,174. The report clarifies that these non-audit fees consist of an SSE number, 16 review of fund accounting and administration operations. So they are paying their auditors for more than just the audit itself, which is common, but it is always good to see what that extra work entails. Okay, let's look at the actual financial statements for the year ending the 30th of September 2025. The statement of operations shows investment income of $7,499,000. That sounds pretty good, but then we see expenses totaling $2,293,000. After some waivers though, the net expenses came down to $2,195,000. This is where we see the impact of those waivers, though the report mentions that had these expenses been excluded, the expense ratio would have been 1.01%. The actual reported expense ratio after waivers is 1.16%. So while the waivers help, they do still contribute to the overall cost of investing in this fund. Looking at the statement of assets and liabilities as of the 30th of September 2025, the fund had total assets of $189,653,000 and total liabilities of $749,000. This gives us net assets of $188,904,000. The net asset value per share was $25.37, which is calculated from those net assets divided by the number of shares outstanding, 744,631 shares. This indicates the fund is holding more cash than liabilities, which is a good sign for its immediate financial health. Now we get to the notes to the financial statements, and this is where the real devil is in the details. Under the significant accounting policies, we see them talk about security valuation. They use a 3-tier hierarchy, level 1, level 2, and level 3 to determine fair value. Level 1 is for easily observable prices in active markets, Level 2 is for other observable inputs, and Level 3 is for unobservable inputs, meaning the company has to make more assumptions. For the futures contracts, which are a big part of this fund, they are valued at their unrealized appreciation, or depreciation, and these are classified as Level 1 inputs. This is important because it tells us their main trading instruments are valued based on market prices, not on their own internal estimates, so that is generally a good thing for transparency. The federal tax information is also interesting. The fund intends to qualify as a regulated investment company, which means it plans to distribute all its taxable income and capital gains to shareholders. This is good because it usually means no corporate income tax is paid at the fund level, avoiding that double taxation issue. They also show the tax character of dividends and distributions paid. For 2025, ordinary income distributions were $8,392,000, and long-term capital gain distributions were $2,748,000. This breakdown helps investors understand how their distributions will be taxed. We also see under other information a section on proxy voting disclosures. It talks about a shareholder meeting on the 26th of February 2025, where shareholders elected trustees and voted on proposals. One proposal was to amend the agreement and declaration of trust to reduce the shareholder quorum requirement from a majority to 1/3. This means fewer shareholders needed to vote for important decisions to pass. It passed with 910935,815 votes for it. This could potentially make it easier to pass resolutions in the future, potentially giving management more leeway. Finally, let's talk about the basis for approval of the investment advisory contract. This is a really important section as it explains why the board approved the fees and services provided by Say Investments Management Corporation, SIMPIC, and their sub-advisor Dynamic Beta Investments LLC DBI. The board did a lot of homework reviewing services, performance fees, and profitability. They compared the fund's fees to similar funds and considered the quality of services provided by SIMPI and DBI. They found the performance of the predecessor fund satisfactory and concluded that the fees and expenses are reasonable. They specifically mentioned that the sub-advisor DBI is compensated by SIMPI, not directly by the fund, which is a common arrangement. So what is the bottom line with CA Exchange Traded Funds and their CI-DBI Multi-Strategy Alternative ETF? On the plus side, the fund has shown good long-term returns, and its core trading instruments like futures are valued based on market prices. The reorganization itself seems to aim for better investor outcomes with lower expenses and intraday trading capability, which is a big advantage for an ETF. However, we do see some weaknesses. The fund has a very concentrated portfolio with only 14 holdings, which increases risk. Its recent short-term performance has lagged behind a simple Treasury bill index, and the reported expense ratio after waivers is still over 1%, which is on the higher side for some investors. The sub-advisor's strategy involves significant gains in equity, but losses in currency and fixed income trading over the last year, indicating a strategy that can be volatile. Looking ahead, the fund's success will likely depend on its ability to consistently navigate complex markets using its derivative strategy and whether those concentration risks become a problem. The board's approval of the advisory contract suggests they believe the current management and strategy are sound, but investors should be aware of both the potential for higher returns and the increased risk that comes with this type of active management. Does this fund offer a compelling alternative for investors looking for diversification and potentially higher returns, or is it too complex and costly? That is something only you can decide. Alright, that is our breakdown of C Exchange Traded Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.